loan rate thing, I think, is a benefit for cash value life insurance as a whole. No matter what you do, IUL should not be your only income source. You have to realize there are risks in that in the policy as well. When it comes to IUL or whole life, when it's sold as an asset, as like a bond alternative, the onus is on you. You should never be selling these unless you understand the product inside and out. Hey, what's going on, Cashflow hackers? It's Chris, Life 180. In this video, somebody sent me a video of Cody Askins talking about the 3 ways to sell index universal life insurance. Now, I'm doing this kind of series and challenge of people that send me videos that they want me to respond to when it comes to index universal life and what people are saying about it out there on the internet, and just trying to get my take on it and kind of give my breakdown about what people are saying and not saying. Full transparency, I don't have a problem with Cody. I like Cody as a person. I've spent some time on the phone with him. We've talked about doing some work together in the past, potentially. But here's what I don't know exactly where this is going to go. I do know that his background is more in like the final expense simplified issue space. That's more of his history. I will see how this kind of plays out. So I'm just going to do what I do and watch this video and ultimately give it a breakdown and give my response and see kind of how it goes. And I guess without further ado, let's just kind of get into this and see what's up.
So IUL has become crazy popular nowadays. I hear literal feedback from agents and questions from agents about selling IUL and how to sell IUL constantly. Now, I'm going to kick this off. I'm going to go through 3 things specifically that you need to know to make sure that when you're selling IUL, you're selling it correctly and that you're actually benefiting your clients long term. There are good ways to sell IUL and there are bad ways to sell.
I'll be interested to see what he says as far as what are the good things and what are the bad things.
IUL. I am not an IUL product savant by any means, so I'm saying it up front. However, one of my buddies in the industry just gave me 3 specific things recently in a phone conversation, about a 40-minute conversation, I think it was, literally just a few days ago, and it pertained to IUL. Also, at any point as I'm going through this, if you would love to learn more about our IUL leads and our IUL appointments, where we actually replace no-shows, you can learn more about both of those at Kaboom Leads.
All right, so what he's doing, and I get it, I don't have a problem with it. I mean, he's selling leads, so he's got to create more content about IUL to be able to get traction on selling the leads. So, okay, I get it. That's fair.
.com, that is, I say boom a lot, caboomleads.com. Okay, so let me get into the 3 things that you need to know. And I'm curious your thoughts, by the way, as we go through this video. I would love some comments. Again, I'm not the freaking greatest IUL person in the world. However, dude, I've got some big-time bigwigs and friends who crush it with IUL. Also, I feel like IUL, by the way, is becoming...
Love his realness. Love his authenticity. That's cool.
...one of the more mainstream products in the world today because of the amount of ads. And a lot of people are comparing IUL to 401k and trying to convince a more traditional 401k investors and companies to actually convert over into investing into an IUL instead. And there's definitely pros and cons of that for sure. Okay, but I'm not going to go through.
I would say that's 100% accurate. That's what people are doing. I mean, the tax-free income in retirement is the #1 way IULs are being sold. If you've watched my videos before, you know it's what I consider to be the most dangerous element of it. Is that's where all the risk comes in on it. So once again, I'll be interested to see how he plays this out.
That in this video, I'm going to go through 3 things that you need to know when you are selling IUL. Okay, the first, it has to do with COI, okay, which stands for cost of insurance. I'm even going to grab my phone and even walk through some notes as I'm sharing this, okay? One thing about cost of insurance is that it goes up every year for the most part, okay? Cost of insurance goes up. Okay, I want you to think about this because, yes, the goal is to invest in a retirement, a tax-free retirement.
Well, so one of the things I need to be clear about there is that cost of insurance doesn't necessarily go up. Cost of insurance, if you have option B as the option for the IUL, then cost of insurance basically goes up every year. Because if you have option A versus option B, what I'm going to do here is I'm going to hit the vibe board real quick, and I'll kind of do a cut here and let you see kind of what we're talking about. But if you have option A, well, I'll say this. I'll start with option B because that's what he's talking about. So option B, or increasing death benefit. What happens is if you start buying a policy when you're 30 years old and you have option B, let's just say it starts off with a $500,000 death benefit. You're going to have the death benefit, and then you're going to have the cash value, right? And so as you build up, and let's say you get to $10,000 of cash value, what's going to happen is the death benefit's going to go up to $510,000 because whatever you add in the cash value will be added over to the death benefit. And so what happens is the reality is you're utilizing an annual renewable term platform, right? So you're using this annual renewable term platform here. So what happens is every year when you're 31, all the way down to when you're 50, or all the way down to your 121 when it matures completely, you're dealing with a situation where it's annual renewable term on the net amount at risk, which is the death benefit minus cash value equals net amount at risk, okay? And so what happens is with an option B, you have this $500,000 death benefit, which when you're 31 years old is cheap, right? That money is cheap at that point in time because $500,000 of single year term at 31 years old is cheap. It's not very expensive as you get down into your 50s. Once you get to 50 to 60 years old, it gets more expensive. And when you get into retirement, it gets more expensive. I'm not going to get all into that. But the reason I'm showing this, because I'm sure he's going to cover more of this, and I just want to make sure this is what he's saying on why it gets more expensive, because you're paying a little bit there and it's going to get more and more expensive as you go, right? And this can be super detrimental. Now, it doesn't have to be that way. You can do what's called option A, which is a level death benefit. The reason a lot of people don't like this because it doesn't allow you to put as much cash value into the policy from a flow. So now if we go back to here and we compared, and let's say you had a $500,000 death benefit, and then you had cash value of $10,000 using the same example, then what's going to happen is you still have that $500,000 death benefit because it's a level death benefit. So because it's the annual renewable term, like we talked about, well, the net amount at risk formula doesn't change. We got 500,000, which is the level death benefit right here, right? Minus 10,000 of cash value, which is the same as we had over here. Then we have 490,000. So now what's happening when you do the level death benefit is that you have the annual renewable term chassis is actually on less and less and less. So it's actually going to get cheaper over time because you're controlling that cost. Now, there are still risks. I'm not trying to say one is better than the other. You got to look at your needs, but it's important to understand exactly kind of what you're getting involved with there, right? And so I think that's just really important to understand. So let's keep going. The one thing I just wanted to make sure that you understood was it doesn't have to be more expensive. Cost of insurance doesn't have to go up every year. It's going to go up every year because of the annual renewable term product. Your cost per $1,000 of insurance will go up, but that net amount at risk and the insurance corridor is something to contemplate.
Account to grow so that later on in retirement, like I own an IUL personally, okay, spend close to $1,000 a month investing in my retirement down the road, but I'm doing.
So I'm not a fan of utilizing the word, and I'm totally nitpicky here, and I'll acknowledge that, but I cannot stand when people utilize the term, I'm investing in an insurance policy. We are never putting money into an insurance policy because we're investing in it, right? And life insurance companies don't invest well. That's not what they do the best. And I'm a super stickler when it comes to words and the verbiage that we use for this stuff, because I think it's super important how we communicate it for transparency with our clients.
That so that obviously that portion of it grows, but because it's still a life insurance policy, there's a cost of insurance still associated with it. Mm-hmm. Well, the cost of insurance, like insurance, as you get older, goes up inside of the IUL. Something to be aware of, and this is
And that cost of insurance that goes up, once again, is that cost per $1,000 of insurance. That's kind of that's the number you got to look at.
We'll put a little, that's a star, maybe an asterisk would have been better, but I don't know that I know how to do that either. An asterisk that it's subject. A lot of this is subject to different insurance companies. I've had insurance carriers that send me an email like, hey, you need to take down this video because price is important. And I'm like, dude, it's important, but it's nothing compared to value, rapport, and taking care of your client. You're never selling down to the penny anyway. And what's funny is the company that told me, the carrier that told me to take down the video that said, hey, price does matter. They weren't even the cheapest on the market anyway. So, and I'm like, bro, if price was the only thing that mattered, people wouldn't sell your product. Let's be honest, okay? That's a side note, but kind of funny.
Don't disagree.
Also, cost of insurance goes up a lot when you start to get into your 50s and 60s, okay, and beyond as someone gets older. That's important because a tax-free retirement account can grow a lot, and then later the cost of insurance could start eating some of that up if you don't think through some of these things properly, okay? And you need to, so I was also told about this recently. These are some new things for me too, and I'm like learning, so I'm curious your feedback. But I know this gentleman sells, 7 figures a year worth of like actual good insurance to high net worth individuals. So I know he knows his stuff. He says that you should never stop paying premiums so that you can continue to cover the cost of insurance. Okay, so number one, cost of insurance. Number two,
that's actually really good advice. That one of the challenges within Index Universal Life is that it gives the ultimate flexibility, so you don't have to pay premiums. On illustrations, a lot of times they'll do what's called a vanishing premium, meaning you fund it for 7 years or 10 years or 5 years, even some people are talking about. And then what happens is at the end of that 5-year period or 7 or 10-year period, whatever the time frame is, it shows the premium going to zero. But what it doesn't show you is that there are actually fees and costs going on behind the scenes. And if you're not managing the cost of insurance as far as like your premium flow goes, then it can become really catastrophic to the policy. Now, I'm not sure what he meant there as far as like paying the premiums all the way through the longevity of the policy. That's really challenging when people are looking to utilize this for tax-free income and retirement. It's one of the reasons I like whole life insurance compared to IULs, because you can never truly pay an Index Universal Life Insurance policy up. It can never be paid up. You can never have it paid off, so to speak, and just be a pure policy that's guaranteed to be there in retirement. Whereas with a whole life policy, we have carriers that can make it so from the age of 65 or from the age time of 10 years after you buy, there's different periods, certain policies. You could do 10 pays, 20 pays. You can have it paid up at 65. You could have it paid up at 75 or 30 years, whichever comes later. And so like there are all these different ways that you can make this work, but whole life insurance, you can actually have it paid up. And so when you start needing to lean on it as a volatility buffer for retirement income or in whatever way that you want to do it, you don't have the cost of insurance kind of dragging on you or being an obligation to you in the background. I think that's really important to understand. So, okay, let's keep going.
Has to do with loans, okay, like loan provisions. Okay, the loan, what I'm being told as well, again, every carrier is different. I'm just giving you some general good information that you should be aware of, is that loan rates are variable.
Loan rates are variable.
Right? I feel like I'm texting now with the R. Are variable. What that means is, right, they can change loan rates later, right? Can change later. You're not buying an IUL so that you can take out a bunch of loans throughout the life of the policy.
Yeah, I mean, I think this is an area that's important. Loan rates are variable. A lot of people are saying that loan rates are guaranteed to be fixed. There are certain carriers that have loan rates that are locked in lower. But when you lock in loan rates lower, there are always other variables that the insurance company injects into the mix, because you got to think about it. They're an insurance company. There's always a risk, right? And they're always managing that risk. And by them giving you a locked in lower guaranteed rate, that's meaning they're taking on more risk, interest rate risk. And so they need to say, all right, there's a cost to us for that risk that we're taking on. And so therefore we need to pass that cost along to the customer some way. So yes, we may be able to lock in this lower guaranteed interest rate, but we're going to have other levers in the policy that we can move to make up for it. And that's really important to understand, because I know a lot of people are going to come back with that. But loan rates are variable. Just like whole life insurance, loan rates are variable, but all permanent cash value life insurance loan rates, the cap legally is 8%. They can't go higher than 8%. So that's actually a really good selling feature for life insurance in this kind of unknown interest rate environment. The fact that you can have all your rates capped at 8% when you look at mortgage rates being higher than that right now. It's pretty sweet to know that even if interest rates get worse than they are right now, which I personally believe is a viable possibility, that your interest rates that you'd be able to access through your policy loans will be lower, which can help control cost of capital, which can open more opportunity. And that's a whole nother thing. But yeah, so let's keep going.
Policy. I know people sell that you can do that. I'm simply saying they're buying IUL so that later on in their 60s, 70s, maybe late 50s, whatever, they're able to take a tax-free distribution from the retirement account as income to supplement their retirement. This is also typically not.
So the other thing I would say here in this video is, he just said it, is he's talking about not borrowing against the policy in the early years of the policy. He's talking about buying and holding and replacing 401ks, basically replacing retirement accounts. It's an accumulation vehicle and a distribution vehicle all wrapped into one. And so fundamentally, I have a problem with that in a lot of ways. I've done a lot of other videos talking about it, so I'm not going to get into the details in that. But you know, the loan rate thing, I think, is a benefit for cash value life insurance as a whole. I think what he's doing is he's talking about the fact that you're buying and holding this asset and you're going to wait till retirement to utilize it, right? And so this is what I've been saying for a long time, and this is the major risk when it comes to IULs, because of the fact that when you do this, most of the time people are not going to realize that they have a problem with their IUL until it's too late, right? And this is one of the things that I keep saying. All these people that are selling IUL on its tax-free income in retirement and like all the ways that it can benefit you, the challenge that I have is the burden of proof is on them, right? We've got a history now of 27 years of IUL, and I haven't had one person be able to show me, and I'm asking one person to be able to show me one success story of a person fully funding their policy and being able to use it in retirement. I haven't seen any of that. What I have seen is a lot of class action lawsuits, a lot of problems, a lot of regulatory updates, and a lot of malicious activity by agents, right? And so when I combine those things and I look at it, I'm like, all right, the verdict is still out on these. So the question is, are you willing to put your hard-earned income into a product that you don't know what the future holds, and it's totally speculative? I don't know about you, but for me, the reason I'm putting my money with an insurance company is not to be speculative with my financial future. It's to have a financial foundation and stability that I can lock in my financial future, that I have this asset that I know is going to be there regardless of whatever happens around me. And so that's where I have a problem with it. So let's see how it continues.
To be their only retirement source, even though most agents also sell it that way. Okay, again,
right.
Loans. Okay.
He just said that. I got to give him credit. No matter what you do, IUL should not be your only income source. A lot of people do that. Doug Andrew is probably the worst of the worst when I see this. You know, there are other people that position IUL as the replacement of a 401k. You should put all your money into that, blah, 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 blah. At least I got to give him credit in saying that you should never have this be your only. And I would also say it should never be your primary. Even if you disagree with me on my overall philosophy and outlook of IUL, I would say that you got to be really, really careful and not even make it the primary. Even if it's not the only, it cannot be the primary, should not be the primary income source in retirement.
When it comes to loans, the loan rates are typically variable, okay, which is important, and they can go, the actual rate can increase later, right? And
they can increase later, the variable rate, but there's also what's called fixed loans or wash loans. The challenge is that the fixed loans and wash loans will have increases in extra insurance costs and the net amount at risk. And that's all about the way it's illustrated. I'm not going to get too in the weeds in this video about that. I've got a lot of other videos that will break down that thing. But for all you agents that'll counter this and say, oh, you don't have to use a variable rate, you can use a fixed loan and a wash loan option, then you have to realize there are risks in that in the policy as well. And I think those risks get dismissed and kind of washed under the bridge.
Right, and the companies can actually do that. That's good to know. Okay, I'm also not trying to shy you away from selling IULs. I'm just trying to share information that I'm being told that I want you to be aware of. Okay, again, I'm not a savant when it comes to products anyway. I'm a marketing guy. I'm a sales training guy, right? I've never been like a product savant that studies flipping underwriting guides, okay? Third has to do with performance. Okay, it can have
I'm a weird guy. I love to train on sales, and but I'm a nerd about the product, because I think if you're going to do sales, you need to believe in what you're doing. You need to know what you're selling, right? I think, when you're dealing with simplified issue, where it's a little more simple and you know exactly what you're trying to do, and you know what problem you're trying to solve. And so what he just said, as far as his mindset when it comes to sales training, is totally cool for most products. When it comes to IUL or whole life, when it's sold as an asset, as like a bond alternative or as a tax-free income vehicle, I think the onus is on you. You should never be selling these unless you understand the product inside and out. And unless you can say you're doing it yourself and that you understand it and you're willing to put your financial future on the line, then you should never do it with anybody else.
You can get a zero. Okay, everybody's selling that there's there's zero risk. Okay, there's it's funny because everything typically has some level of risk naturally. However, can the floor of a IUL product be zero? Let's just say S&P 500 gives a negative 18%. Okay, can the policy be credited with a zero, actually receive a zero, and not the negative 18%? Yes. However, you still have to pay for cost of insurance, as we talked about earlier. What does that mean? That if a policy gets a zero on a down year, okay, which is good, there's some security there, that's great, they're still having to pay the cost of insurance, which means the account could actually go backwards, okay, because you have to pay for cost.
Okay, so here's the deal. I'm going to take this to the next level, right? And I'm going to, what I want to do is I'm going to actually come back over here, because I have a thing to show you. I want to get into one little thing here to show you, is that he's 100% right. I got to give him, my head's cut off. I got to give him credit where credit is due, in the sense that he is saying that when you have a 0 year, it doesn't mean you're not going to lose money. You can lose money, especially when you're in retirement years, where the cost of insurance is more expensive, right? So that's one thing. But the other part of it is I'm going to go to the board here, is that the loan rates, and what I want to do is I want to get down here, and I've used this before to kind of explore and use it to educate people when it comes to loan expenses and the policy loan ledger here. So I want to get here. Now I use this for a different video, so you can see here is something important. But this is just one example. Once again, every company is a little different. Every company shows different loan rates. They all kind of illustrate a little bit differently. But one of the things that I want to show here that's really important to understand is that when you look at the fact that, this person, let me go to the screen before, just to give you context, they funded it, for a period. They started younger. They were 41 years old when they started, and you can see at 61, they started taking an index loan, meaning a variable loan, index loan, versus a fixed loan. A fixed loan is a wash loan, and an index loan is a variable loan. Every company calls it a little differently. Just to give you context, that is what that means. So what happens with an index loan, they're assuming 50 basis points of spread, positive spread. Let me show you what this looks like. So this is the danger in these in retirement, is that it's showing you 37,884 is the loan, and it shows your loan charges are 1,026, but it shows your loan credits, meaning what you're getting credited for in the illustration, even though the illustration is not real life, is showing a positive credit of 1,168. So there's a positive spread here, right? So you're earning more money than the cost. That is how these illustrate so well. But the problem is reality doesn't exist on a spreadsheet. Life doesn't exist on a spreadsheet. And here you can see that at the end of the 5-year period, you got $189,420 of income. You've paid $25,000, $582 in interest expense, but you've earned, according to the illustration, because it's assuming you have positive spread every single year, $29,462. Now, what does this mean? You have this outstanding loan balance. Take a look at this. Okay, now I want to go over here and show where the danger is in this. Okay, because what happens is I want you to see this, and this is something where when he says he's not a product nerd, you need to understand this stuff, because this is where the risk is. The people use these accounts and they try to accumulate money all these years, right? They try to accumulate all this capital for all these years, right? And they go through and Then they start distributions, and they're banking on this $37,884, right? Then you look at the annual loan charges right here, and then we have the cash value. Now you can see, even with this positive spread, even though you're getting charged $11,776 and you're earning $13,584, so there's a positive spread of almost $2,000 there. Look at this though. Even though that's the case, look at the cash value. $373,000, then $363,000. Even though you have a positive spread, it's going down every single year based on the assumptions that were built in this illustration. And so it's going to look really positive and really sexy, really attractive, right? But here's the problem. By the time we hit, so he says you can lose money on because of a 0 year, because of the cost of insurance. It gets really ugly when you start talking about loans. Let's say this person's relying on this. When you retire, the odds of living past 80 are really significant. Well, check this out. The challenge is, by the time you've hit this place, you've had a total annual loan charges of $528,000. Okay, that's what you have in loan charges. You've earned $610,000 of credits. Okay, so it's saying you've earned about $70,000 more, almost $80,000 more than you've actually paid. So that 80,000 here of positive spread is an assumption that is not realistic. Now, here's the other thing that comes to think about. It's assuming that every single year here, I'm going to use this, every single year with these assumptions, with these loan credits, are positive. Okay. Now, I don't know about you. I don't think it's going to be hard to convince you that at least, some of the times you're going to have negative years. And so it's going to throw a wrench in your plan. The statistics are 35% of the time, the expenses are going to be more than the cost of than the loan charges. So your expenses are going to be more than the loan charges. So in this year, and what I mean by expenses being more than the loan charges, meaning the performance of the market is going to be less than the cost of the loan. So if this loan charge was 5%, it means 35% of the time, the market is going to perform under. Now, he said it's a variable. So if this goes up to 7% on the loan, then that number of 35% of the time actually will go up. So these are the variables that you don't know. And we're planning 30 years out. So why are we going to take this kind of risk, right? And so now we go here and we look at this and we say, all right, at age 75, let's take a look at age 75. We have 37,000, this 1 year of income. Okay. What do we have here? We have an $839,000 outstanding loan. Okay. So what does that mean on a 0% year? Okay. On a 0 year, I'm going to do the math here. 839,622 times 0.05. That means you have, I'm going to do this on this year right here. Okay. On this year, you have 41,000. So what does this mean? At 75 years old here, this 1 year, check this out. Check this out. This 1 year, you have $280,000 of cash value. You have an $839,000 outstanding loan balance, right? Now, what it's assuming though is that you have a positive year, that the market does 5% or better, right? It's actually saying you're expecting, if the loan rate is 5%, it's expecting that the market does 5.5%. That's what it's expecting. But now on a 0 year, not only do you have the extra cost of insurance, but you have this $45,000 of loan credits that's built into this. So this 280,000, I'm just going to round numbers off, minus 45,000. Okay. That doesn't exist now. So not only do you have the extra loan costs, but now you have this, or the extra insurance costs. Now you have the loan credits that are not being credited to this policy, right? And so now you only have 225,000, 235,000. Okay. And if I were to look at this, and by the way, this is in retirement, and this is only on a 0% year, right? A 0% year. I go 245,000 divided by 2. That's a 16% loss, guys. Okay. So this is the danger in IUL. It's not while you're accumulating money, but what he just said is it's you're going to buy this product, you're going to hold it, you're going to accumulate, and then you're going to try to lean on this income. And there's so many variables that are outside of your control. And this loan risk is the number one variable that people just do not realize that they're dealing with. And so I really caution everybody to be super, super careful about that. Now, once again, he's not, I can't give Cody too hard of a time because of the fact that he's self-admittedly not a product expert, but I would argue with him vehemently against him that you have a responsibility to understand these products beyond even this level. What I'm talking about in my mind is very surface level stuff. I know to a lot of people it's kind of deep, but these are the things that you need to understand, and it's beyond cost of insurance. The loan risk in IULs are absolutely crazy. Now, a lot of people are going to say, well, you could do a wash loan and guarantee that you're going to get the credit that you're going to have. But the problem is now the cost of insurance risk actually gets bigger and bigger and bigger because you're not cutting into the net amount at risk the way that you are with this. And if you have any questions about that, you can just go down in the link in the description below and you can get on the phone with my team. If you have an IUL, you're looking at it, you're considering it, I would say reach out and somebody can help you. But you need to understand that stuff.
For cost of insurance, okay, which is important. Also, what I'm being told a good way to sell an IUL, again, this part I just learned about as well. I was like, oh, that's actually kind of cool, is that you should reduce the death benefit down the road. Well, why would that make sense? It would make sense to reduce the death benefit down the road simply because cost of insurance goes up way more in your 50s and 60s, but if the cost of, but if you're the actual death benefit is going down, because if you have the same death benefit and premiums are going up, okay, same death benefit, premiums are going up. However, if you have a reducing death benefit as your premiums are going up, that will actually start to stabilize the cost of insurance.
So I have a problem with this is like just philosophically, if we have to reduce the death benefit to accomplish that, what's that doing to our legacy? What is the cost of that? That's first and foremost. Secondly, when a lot of people sell these things for living benefits, well, what's that doing to the living benefits as you're taking loans and reducing the death benefit? He's not wrong. It is a way to reduce the cost of insurance, and reducing is what we call closing the corridor or shrinking the corridor, meaning as you get older, you need less and less death benefit as a percentage as it relates to the cash value in the policy. So you can shrink that. So what a lot of people do is they will say, all right, in the years that we're funding the policy up until say 65 years old, we will keep it as an increasing death benefit. I'll use the $500,000 of insurance example that I used. So you grow to $1 million. Now you have a $1.5 million death benefit because it's the cash value plus the death benefit. That's what the increasing death benefit does. Once you turn it off, now you switch it to a level death benefit, meaning that 1.5 million is now your fixed death benefit. And as the $1 million grows, the death benefit will stay the same. And that corridor between 500,000 and 1 million will also start to shrink. That will reduce your annual renewable term charge because, let's face it, if you have $480,000 of insurance with net amount at risk for the annual renewable term when you're 65, it's going to be cheaper than with 500,000. And every year as that goes down and your cost of insurance goes up, if you can shrink that corridor, that's even better. There are also ways that you can hyper compress that corridor, meaning you could say, all right, we're at $500,000 of death benefit. Maybe we only need 300,000, right? So you could reduce that and you can shrink it and compress it. It's going to help. I'm not going to dispute that. If you're going to do this, that is the way to do it. You're going to optimize by shrinking that, and it's going to reduce your cost of insurance, but it doesn't eliminate the loan risk that I was just talking about, which far supersedes and trumps the risk of the cost of insurance that you're going to have in these policies. Far supersedes. So you need to be aware of all these different things and be very, very, very cautious. Let me get this going again.
Okay, just a different way of thinking. At the end of the day, I'm not saying that, I don't believe in IUL, because I do. I think there's a place for it. I think if it's sold correctly, it is great. I think the fact that it's going mainstream is cool. I do know that there are individuals that are selling IUL as like the end-all be-all, the only option on the planet.
Yep.
And I love it, okay? I'm a believer in it. I own one. I think it's really cool. I think it's good for our industry.
I think it's bad for our industry simply because of the way people are selling it. I have no problem with IUL as a product. right? The challenge with IUL is it wasn't built to be an income product. It was 12 to 13 years after the fact that it came out that it started really being leaned on as an income product. And that was all marketing. It had little to do with the actual product and why it was created.
I think that with anything, this could be true for fund expense, Medicare, whatever, there are people that sell things correctly and people that sell things incorrectly, or people that just are doing it for a paycheck versus actually taking care of the client and doing things the right way.
Yep.
Okay. Also, we have different trainers that actually come in and teach some of this stuff in our academy at ultimateagentacademy.com. So if you're newer to the industry or newer to different products, I coach every Monday live, not super product specific. However, we bring in millionaire trainers every other Wednesday inside of our academy to help our members with additional knowledge around different types of
I just give free training on YouTube
ultimateagentacademy.com.
I don't want to charge
$49 a month
people
and
for
be a
it.
part of our academy, and we can help you grow in our community. Also, these were 3 things to actually really information to help you better at selling IUL and just knowing more about IUL.
Yeah, I think this is the end of the video. I mean, so you know, to Cody's defense, he fully said he was not a product expert.
IUL appointments,
he fully said
they're both
like, he owns
available
one,
at
so
kaboomleads.com.
he obviously believes in
we
it
could also help you
to a
build
certain
your
extent,
own
and so I'm going to take
lead
him at his
generation
word on that.
campaign and actually manage
So it's
an
hard
ad for
to
you
bust
as
his
well.
chops about
One
that.
is, hey, I just want to lead your
I think
appointments.
he means
One
well.
is
I
that I
know
want to get
his
appointments and
business,
leads
he's
at
grown,
cost,
he's been successful.
and I want to use my brand. And Cody, I want your team to
so,
manage it for me. For that,
you know, I think
you can go to
Cody has
CodyAskins.com/lead-gen.
a high level of integrity
One's
and
ad
means
management
really
related.
well.
Hey, we'll manage
The
your ads.
challenge
Cool.
that
We'll get you leads at
I
cost.
have
Great.
is just
Or,
a difference
just
in
want to buy 'em.
fundamental
kaboomleads.com.
philosophy.
Perfect.
There's
Either way,
no proven track
I like
record
IUL.
with IUL.
I love
In
what it's
fact,
doing
the
for our
proven
industry.
track
It is
record
taking off. It's
is
going
that
mainstream. I'm
they've
seeing IUL
underperformed,
everywhere.
that
We
there's
actually
been
had
a
an
history
agent
of
that got
regulatory
they
change
got a
and
lead the
class
other night.
action
One of our IUL
lawsuits
leads.
and individual
And the lady on the
lawsuits.
other end of
Just
the phone
look
said,
it up.
yeah,
It's
I was at
all
work.
available.
We were talking about
And so
retirement
to
and
me,
401k, and a
with
guy
a
came to me
product
at
that's
work
been around
that wasn't
27
an insurance
years,
agent.
if everybody's
also,
saying you can
employee hanging
utilize this
out
product
at a company
as
with me,
an
and they said,
accumulation
you
vehicle
should
that
look
you're
into
going
an
to be able to
IUL.
use
First
for
one wasn't
tax-free income and
licensed, but it's
retirement
so
and all this
mainstream.
stuff,
Person's like, you should look
I
into an
don't
IUL.
want to be
And
the
the
guinea
agent's like,
pig on
yes,
this.
you should.
I'm not
And they were
putting
able
my
to help
money with an
that
insurance company to
consumer
take a risk. I'm
prospect
doing it
with
because
an
these
index
companies have been the most
universal life.
successful
Hope you
financial
have an amazing time
institutions
selling
in the
IUL.
history
We'd
of the
love to learn
world.
more.
And the
We're
challenge
here
that
to
I
help
have is
any way
that a
we can,
lot of
and I'm
agents
gonna
are
keep trying to do
positioning
different types of videos, even though
the fact that you should put
products
your money
similar
with a
enough
life
to be
insurance
dangerous,
company
and I
because of
promise
the
you,
fact that they have this
still
big
selling.
longevity
But make
and
sure that you're
history
doing the right
and
thing. If we can help you with
success
anything,
and
please let us know.
consistency and
Let me know in the comments below
predictability.
what you thought
But the
of
bottom
this
line
video.
is that's only
If you enjoyed this,
relevant when you put your money into a
It's
mutually
right there. Click on it.
held
See it.
company
I'm
that
so
gives
excited for
you
today's
participating
CA
mutual
Power Player
policy,
podcast.
meaning
I'm
you
just
get a
Cody Askins.
dividend
We're gonna
and you
special
participate
guest.
in
He's back on the
success
channel.
with the life insurance
Talking
carrier.
about how to sell
With an
life
IUL,
insurance
you
from
literally are
home.
just
Here's
profit
what I love
center,
about this
even if
podcast.
it's with a
It's
mutual
really
company.
good.
Make no mistakes about it. And so the insurance company could still be successful and you could still lose all your money in your policy. That's the biggest difference. So I would say be careful. If you have any questions, comment in the comment section below. Any comments, go ahead. I'm happy to engage with every single comment I see. Do your best. You know, if you have a policy, if you're interested, if you've been looking at this, go down and link in the description below. Set up a clarity call. I'll also put it as the top pinned comment. You can set up a call with one of our folks. I'll also put the link in the top pinned comment to my Index Universal Life training playlist that I think would be really, really beneficial. I think it's the best training on the internet when it comes to really doing deep dive understanding on Index Universal Life. Once again, if you get through it all and you understand all the moving parts and you still think it's for you, well, then God bless you. Good luck, right? The reason I shifted from being the director of business development for one of the top IUL companies in the country to being a raving advocate against IUL and for whole life is because while I was there working in the mothership, so to speak, and the way they taught, they made it sound like it was this no risk situation, you know, and I would say it is anything but that. And you got to be really, really cautious. And the way they were teaching us to pitch IUL was really the way that when I looked at the principles and the values and why I was doing it all, that's what got me to realize like, oh my gosh, when I saw whole life insurance and I really started to understand it, it was like, that's it. And now it's to the point where even in whole life insurance, there are indexed options for dividends. So you can have the upside potential that IUL offers with none of the downside risk. So if that's something of interest to you, make sure you reach out, set up a clarity call in the link in the description below. We're happy to help. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.